So I'm finally done with the full video of the MNC stock I told you guys about last week. As some of you might have guessed from the hints I gave out in that video, this company is Orient Refractories Limited or ORL. Normally I do not get as excited talking about a company, but in this case cheap valuations are pointing towards multi-bagger gains in the future for this small cap gem. To find out why I am so upbeat, keep watching. Also, remember to like, share and subscribe. ORL was acquired in 2013-2014 by RHI Magnesia of Austria. Prior to this, the Rajgiriya family owned and managed the company. RHI Magnesia is the number 2 player in refractories globally, has India as its second largest single market in terms of revenues after the US. India is also one of the fastest growing markets for RHI. It sees India as a high growth market for itself. It operates in this geography through 3 entities, namely ORL, RHI India Limited and RHI Classel Private Limited. Due to the association and support of RHI Magnesia, there are good prospects and strong competitive advantages for ORL going ahead. Thanks to RHI, ORL has started exporting a fair share of its output, approximately 25%, to various overseas customers. The major export customers are based in Europe, Middle East and Southeast Asia. ORL's major clientele in India includes SAIL, Bhushan Steel, Sunflag Iron, Lloyd Steel, Mukund, etc. Orient Refractories Limited is a manufacturer of wide range of refractories and monolithics for iron and the steel industry. A refractory material is one that retains its strength at very high temperatures. It is used in linings for furnaces, incinerators and reactors. The iron and steel industry uses approximately 70% of all refractories produced, with the balance 30% coming from the cement, glass and non-ferrous segment. In terms of segmental revenue, 70% of ORL's total sales come from refractory sales, while roughly 30% come from income management services. More on what this income management service is a little later. ORL still depends heavily on the steel industry for its revenues. The steel industry in turn is dependent on the infra construction and auto for the majority of its revenues. In the current medical crisis, both these sectors have taken a hit. Also, owing to the large expenditure undertaken recently by various governments throughout the world, they might go slow in terms of their construction budgets in the near future. Also, auto demand is deemed to be a bit sluggish in the near term due to high costs of ownership and continuous disruption in the auto industry. So, what makes ORL special? ORL operates as an oligopoly. ORL only has a few competitors in India. Having limited competition ensures good and sustainable profit margins for all players. Orient and Vesuvius are the major players in the market. Orient has a higher profit but a lower PE compared to Vesuvius. Refractories are used in making steel through a process known as EAF or electric arc furnace. It's becoming popular world over. In India, majority of the steel productions happens by way of EAF. The first benefit is that the use of electric arc furnace allows steel to be made from 100% scrap metal feedstock. This greatly reduces the energy required to make steel when compared with traditional steel making. The regular blast furnaces cannot vary their production by as much and have to remain in operation for years at a time. EAFs can be rapidly started and stopped, allowing the steel mill to vary production according to demand. In the world's largest producer and consumer of steel, that is China, less than 10% of steel manufacturing happens by way of EAF. With an ample and growing supply of scrap metal, China has been steadily increasing the use of EAF. This is great news for ORL as its exports should rise as a result of this shift. I spoke of refractory management services earlier, which contributes close to 30% of ORL's revenues. In the steel industry, refractory bricks last from a few hours up to a few weeks at best. Therefore, these refractories need to be replaced by new or recycled ones on a regular basis. This ensures constant and steady flow of business to ORL. During the end of the second quarter of FY20, the company has completed the acquisition of Orient Refractories and Ceramics Private Limited for its new business of manufacturing magnesia carbon bricks. Until recently, ORL was importing this product from China. This acquisition gives ORL the advantage of backward integration, namely supply chain control and lower costing. Also, to increase revenue further, ORL acquired another company named Intermetal Engineers India. The senior management, led by the MD and CEO, Mr. Pramod Sagar, has an experience of more than 25 years in this field. The attrition is also very low at ORL, which is a sign of stability and continuity at the company. In July 2018, RHI Magnesia announces plans to merge its two unlisted subsidiaries, namely RHI India and RHI Classel, with ORL for better operational efficiency and simplifying the holding structure. Post-merger, ORL is proposed to be renamed to RHI Magnesia India Limited. As per RHI, the merger will help in enlarging product offerings due to pooling of management, expertise, technologies and other resources. Hence, the merged entity will be better placed to attract large deals even from Tier 1 steel producers. In addition, exports are expected to see an uptick from the current 25% to over 30% by 2023. The transaction is also expected to increase EPS. According to Pramod Sagar, the MD and CEO, the merged entity is aiming to double its market share in India to 40% in the next 3 to 4 years. The total refractory market in India is estimated at 8,000 crores. What this means is RHI Magnesia India Limited expects to take revenues to about 3,200 crores by 2023-24. However, the merger was rejected by the NCLT in March 2020. NCLT is of the view that such a transaction would result in undue advantage to the shareholders of RHI India, RHI Classel and ultimately the holding company RHI Magnesia. On the 18th of March, ORL filed an appeal to the NCLT against the order dated 2nd March 2020 of the NCLT rejecting the proposed merger. I feel ORL would have made some changes in valuations to get the approval. This would benefit the existing shareholders of ORL. Also, I expect the merger to come through latest by 2021. The merger not going through is suppressing the valuations of ORL. On all parameters, Orient is the best refractory company in India, as can be seen from this chart. Still, it trades at a discount multiple to the likes of Vesuvius India. At current market price, ORL trades at 16 times its estimated FY20 EPS of Rs 8. Given the fact that the company has zero long-term debt, high ROC more than 25% since RHI took over, and backward integration due to recent acquisitions, I value the company at 22 times its estimated FY21 EPS of Rs 8.4. This gives us a price target of Rs 185. This is a very conservative target because Orient has been trading consistently above a PE of 25 for the last few years. Also, Vesuvius still trades in excess of a 20 PE multiple. Also, I am taking only ORL, the standalone entity's EPS, into consideration. If the merger goes through in 2021 as expected, EPS of the consolidated entity will rise to approximately 11 rupees and as a result, the target price will move much higher. If you would like me to analyze a specific company, please leave your suggestions in the comments box below and I will try my best to cover the same. Wishing you guys the best of health and wealth and hope you've enjoyed this analysis. Ciao.